Okay, welcome to the Personal Finance Buying a Home presentation lecture. Please make sure that you follow along with the presentation lecture as well as answer the embedded questions as they come up, as there are many aspects to buying a home that you may or may not be aware of. So let's take a look at some of the costs and risks associated with buying a home. All right, when it comes to buying a home, what a lot of individuals will do is they will take out a mortgage. A mortgage is the lending term that is used for the amount of money that is lent by a financial institution to individuals in order to be able to purchase a home. Let's watch this short video on what are mortgages by Wall Street Survivor. Okay, so a very interesting short little video on how mortgages work, how they can be advantageous to a consumer looking to purchase a home, as well as some of the advantages to purchasing a home. Now, when it comes to qualifying for a mortgage, a financial institution is going to look at many different factors. Some of them were mentioned in the short video. The amount of the mortgage for which you will qualify for will be influenced by your individual income and possibly even your spouse's income, the amount available for a down payment, as well as current mortgage rates. So all of these are going to impact whether or not a mortgage can be obtained and how big of a mortgage can be obtained. Now, when it comes to also qualifying for a mortgage, there are other factors to consider. First of all, estimated value of the home that you would like to purchase, also known as an appraisal value. The down payment, the amount that you can put down up front before purchase. Reduce other debts or improve your credit record. The better your credit score, the more you will qualify for, and potentially even the better interest rate that you will be able to receive. Compare fees, services, and mortgage rates for different lenders. Don't just go with the first one that you check out. Make sure that you take a look at a number of different options. And prepare your mortgage application. A lot of these can be done over the phone or online. They're not necessarily paper and pencil anymore. So it has moved quite a bit with obviously with the availability of technology. Now, when it comes to different types of mortgage, a fixed rate mortgage, which means fixed payment, which means no matter what happens over the course of the term of the loan, the payment will remain the same. These are conventional 30-year mortgages. You can as well get 15 or 20-year mortgages in some instances. FHA or VA fixed rate mortgages are also available, and there's also what's known as a balloon mortgage. Balloon mortgage is going to lock you into an interest rate for a fixed amount of time, possibly 3 or 10 years of that 30-year mortgage, and then after that it will balloon based off of the current rates. Also known as an ARM, which is an adjustable rate mortgage. Those are variable payments. Those are adjustable rate mortgage, which means that the rates will move with the health of the market. Graduated payment mortgage and growing equity mortgage. So there are a number of different options available. You have to take a look at what's going to best fit you and your current financial situation and the home that you are purchasing and go from there. PMI, private mortgage insurance. This is normally used in instances where the purchaser cannot put 20% down or more. This is going to reimburse the lender if you are in default of your home loan, thus protecting their investment of lending you money to purchase your home. You, the borrower, will end up paying the premiums in order to obtain that mortgage and protect the lender against the borrowing. Fees will vary depending upon the size of the down payment and your credit score, and normally around 0.3% or about 1.5% of the original loan is the amount that has to be paid to PMI per year. Closing costs. Once the purchase price has been agreed upon, the mortgage has been obtained, now it is time to close, to complete the process of taking out the mortgage and begin paying on it on your home that you've just purchased. So when it comes to closing costs, these are usually passed on to the buyer, and there's a number of them. There's a title search fee. You have to title the home in your name. There's title insurance, which is going to insure the home. There's potential attorney fees to make sure that the documents are correctly generated, formatted, and signed. There's also an appraisal fee, which is going to determine the value of the home that you are purchasing. Recording fees and transfer fees, these are filing with the title companies and such. There's also the pulling of the credit report, which is not free by the lender. Termite inspection, to make sure that the house is safe and there aren't any insects or any other risks involved with the purchase of the home. Usually those can be found with a home inspection. Lender's origination fee, which is usually about 1 to 3% of the loan amount. Reserves for home insurance and property taxes. Amount varies depending upon where you live. There are property taxes associated with owning a home, and there are some states that are less than others. And then obviously the interest that is paid on the loan. Sometimes it can be paid in advance if applicable, depending upon your agreement with your financial institution. And that concludes the presentation lecture on buying a home. Hopefully this gives a little bit more insight on what it's going to take in order to purchase a home, so that when it comes to that point in time for you, when you are ready to purchase your first home, you are prepared and able to do it with little stress. All right, so make sure that you have answered all the embedded questions, review the material as needed to prepare for upcoming assessments, and we'll see you next time we meet in class.